theme for our closing panel is consolidation and new growth opportunities for VCs in India. It's like the dessert at the end of an extravagant meal, sweet, satisfying, and a little bit surprising.
So first off, at the buffet, we have Ashish Fafadia, partner at Blume Ventures. Ashish is known for swinging for the fences, turning bold ideas into bigger realities, a true slugger in the venture capital game.
Next, we have Hero Choudhary, managing partner at BeeNext. Hero not only lives up to his name in every deal he closes, but also in the way he champions new ventures. He's the kind of hero every startup dreams of having in their corner.
Joining them is Gopal Jain, co-founder and managing partner at Gaja Capital. He's founded Gaja Capital in 2004 and since then has been steering the ship of India's leading mid-market private equity firm right here from Mumbai.
And let's not forget Visalakshi, managing partner Tata Capital Healthcare Fund. She has spent nearly 3 decades across healthcare, private equity, equity research, and pharmaceutical R&D operations.
And guiding this stellar lineup, our final discussion of the day is Ashish Wadhwani, co-founder and managing partner at IvyCap Ventures.
So sit tight, engage, and get ready to be inspired. This is the grand finale you won't want to miss, where ideas meet investments, visions turn into ventures. Thank you.
Thank you, everyone. And I have with me some very, very distinguished, panelists, and I hope that they can sort of, end the session with a flourish, right? So let's just go around the table. And what I would like you to cover is really what your fund does, what is the focus of your fund, and what stage do you come in, what industries you like. So some kind of a focus. What exactly do you do?
Sure. Thanks, Ashish. Thank you, IvyCap team, for having me over. So at Blume Ventures, we start our journey with portfolio companies pretty much at the very early stage during the time they are evaluating or considering their businesses to a little later when they have some bit of product market fit on the path. So pre-series A and seed investments is where we typically look to start. We start off the journey in 2011 and we are a team of a leadership of 10 people, including 7 members on the investing leadership. And the focus areas, typically we have had about 60% focus on everything which is built from India for the Indian consumer. So consumer tech, including platforms, e-commerce, and the likes. And about 40% is around deep tech, enterprise SaaS. So it is Indian tech for the world in that sense. And within that, pretty much open to every other vertical. So over the last 13 years, 150 plus investments, 30 plus exits across 4 funds, fintech, health, EVs, name it, and probably within the tech ecosystem, whatever verticals do stand relevant with the tech spine, we have been open about it. And over a period of time, we have been open to add new thesis areas and evolve. Thank you.
And what's your favorite sector, Ashish?
I look after fintech and growth. Growth is a horizontal, fintech is more from the specialization.
Great. Hero?
Hi, everybody. Sorry, yeah. Thanks for having us. Thanks for having me. I am a managing partner at a fund called BeeNext. We are based out of Singapore. We started in 2015. And in our first product, we were investing across India, Southeast Asia, and Japan in early stage companies, pre-seed, seed. Fast forward it today, as market evolved, we evolved. So today at BeeNext, we have total 3 different products. One for Japan, incubating only the SaaS businesses in Japan. And the other 2 products are on India, Southeast Asia. First one is focusing on early stage, pre-seed, seed. And second one, what we call Accelerate Fund that invests in Series B and C. And Accelerate Fund focuses on finding category-defining companies that can be built from India for the world, and something very similar in Southeast Asia. Today, we have 43 team members spread across India, Singapore, Indonesia, Vietnam, and Japan. We manage close to 12 funds AUM, just shy of $1 billion.
And what's your favorite sector?
I like all the sectors, sector agnostic, but most amount of investments where I'm involved, they are in fintech. I focused in early days of BeeNext in the early stage companies, and now I lead all of the Accelerate fund that does Series B and C into the companies.
Hi.
Go ahead.
Hi. Thank you so much, Vikram. Thanks, Ashish, for having me here. It's really a pleasure being here. So I'm Visalakshi. I am the managing partner for Tata Capital Healthcare Fund. We are a dedicated full spectrum healthcare and life sciences private equity fund. We now manage across two fund vintages, combined about $200 million this, and dedicated growth capital investing anywhere between, I would say, $7-8 million right up to $25 million is our ticket size. We also do on a very selective basis early stage investments. So predominantly our theme for investing is across, I would say, an India consumption story, where companies generate cash flows from the home market, and a competency, a global competency story, which is more like companies which are more outward and export focused, a CDMO play or a global health tech play. So that's our broad two themes. So broadly, when we invest, we do only significant minority investments and with your normal standard private equity rights, etc. From a portfolio theme perspective, we are looking at some kind of a moat, which could be in the form of, say, identifying the, some kind of shifts in the business model, or it could be where there is a huge unmet need in terms of what the company is addressing, or it could be where there is an ability to expand reach both geographically or in terms of the product profile, or for that matter, even if there is a technology edge or some kind of a customer edge. So these are some kind of broad modes when we look at portfolio investment. So far, we've done close to 19 investments. We've got like seven exits. And yeah, that's where we are right now. Thank you.
Gopal?
Thanks, Ashish. Thanks for inviting me. I work at Gaja Capital. Gaja Capital is a mid-market growth capital investor. Just to make it simple, we invest at a stage after IvyCap. IvyCap is an extremely important firm for us. It's like us, of course, it's not always easy to invest in their portfolio companies, because when they become successful, everybody wants to invest in them. But we are always looking to invest in the companies of IvyCap. And what are the sectors we invest in? We invest in hyphenated tech. So our traditional sectors like education, consumer, financial services have techized. People refer to them as ed tech, consumer tech, financial tech. We've also started investing in enterprise software. Now there is a market for enterprise software in India. We are not shy of investing in enterprise software companies that have entirely rupee revenues, because we believe we can do a damn good job of helping them become dollar revenue companies. I've been personally investing in markets for a long time. I raised my first India fund 26 years ago. I made my first private investment about 29 years ago. And I made my first public market investment about 40 years ago. So I'm really looking forward to these discussions.
Really amazing. So basically on my right, more early stage and maybe a little bit mid-stage with Hero. And on my left, I don't know whether you like that label, but more sort of later stage and more mature companies. And we also have a fair diversity of sectors. So let's drill down into sectors a little bit. And Ashish, you mentioned fintech. And we've seen a big lending and first payment and lending. What are the big themes that you're seeing out there today?
So I think just a step back, when we looked at fintech in the first few years of the ecosystem, back in 2013, 14 onwards, sorry, everything practically was around payments. And then came this wave where everything started shifting more towards lending. So much so that people who were trying to create some form of a marketplace offering as well, eventually were looking at adding lending as a area to make sure that they were able to expand their offerings or make sure that the flywheel kicks in at some point in time. From there on, I think over the last 4 or 5 years, more particularly post-COVID, we have seen a very significant surge in opportunities and validation around the infra and the guardrail space as well, which means that earlier when you were trying to take a company into information security or audits and verification, it looked to be a very odd one. It used to be very niche, and people would be skeptical if somebody would look at growing these companies or how much would banks spend. But today when you look at everything around infra layers, banks have a very significant spend that they are making, plus they are spending outside of the businesses as well to make sure that they're up to speed. So I think infra in fintech is definitely moving ahead. And when it comes to fintech and infra, it's hard not to recognize the fact that India has the potential to make sure that we can drive our infra network and infra startups outside to the globe as well. We are in a very strong position thanks to the digital public infrastructure that we have. We have a big headwind that came in the form of COVID, and I think people could sustain just because of the fact that we were advanced in some of these technologies and we were able to make sure that things ran. COVID 5 years ago would have crashed the whole economy and the country. So I think we have a template in the combination of the digital public infrastructure, our startups, our quality on the tech side there is way ahead of most other companies and countries in the world. The other aspects of fintech, these days we have a massive opportunity starting up with respect to wealth and the alternatives as well, whether it is debt. Hitherto everything around wealth was around equity. Things are moving in the direction where debt, which is actually much bigger, is now coming as a part of the whole recognition. The key thing here in fintech is how are we going to look at the development of the regulatory landscape? Because in as much as we do talk about competitive players, incumbents versus startups, I think the biggest competitor or a factor on any financial services play is going to be how the regulations shape up. To that extent, I would even go out there and say that government could end up potentially being looked upon as a competitor. It could have a final say in how the sector shapes up for the right reasons by and large. So one needs to be mindful of that, and anything which is going to be building within the realms of regulations, which are fast forward compliant from a 5-10 year lens, has a much better opportunity set. So that's what I see as the key factor. And the other also factor which I feel is fintech is also vertical where a lot of cusps can happen. So you will have insurance embedded with products. You will have credit embedded with the marketplaces, etc., which we discussed earlier. So there is a massive opportunity to look at fintech as much more sophisticated offering and the layer. So that way it transcends and becomes horizontal in that sense. We recently published an InsurTech report, and while we may talk about just 4-5% of the country to be insured, the bottom 30-35% is going to be taken care of by the government. So one can get really creative on how you're going to solve between 5 and 65 as a percentage of the population. That itself is a massive opportunity. So these are some thoughts. I don't want to keep on and on, but yeah.
No, great. So infrastructure, wealth tech, alternate assets, insurance, and even finance fintech as a horizontal play, embedded, right? So those are great themes. And I'll come back to some of them because I think it'll dovetail into some other topics. But moving to health, health has been sort of around for a long time, and health tech like education, ed tech, and agri tech, they're health, agri, construction, education, these are very large sectors. But adoption of technology has been relatively fallen behind at least expectations. So what are you seeing as opportunities there?
So I must caveat this by saying that we are largely a growth capital fund, and for us as a portfolio, health tech is probably a very minuscule portion, right? Given
And
the
why
fact
is that? Because you
So, I think
do a
it's-
lot of health, and I think in your
Yeah.
right judgment, you're not doing a
Sure.
lot of health tech.
Yeah.
So what are the issues?
So it's a function of scale and profitability. So clearly, I think all the health tech companies that we have seen, at least very few of them have reached especially the profitability levels that we would like to, when we are starting to invest. Having said that, our approach to health tech is, given the fact that we have a healthcare focused fund, is that companies which are able to demonstrate some kind of ability for overcoming a clinically unmet need. So that's the way we have focused on. So the one company that we have invested is a company in the radiology AI space, where and post our investment, the company has migrated towards a multitude of regulatory challenges. They now have a US FDA approval, and they have a full-fledged platform for a chest X-ray for radiology AI, as well as this. So here the unmet need that they addressed is that, so what you'll see is that over the last decade, the scan volumes, like be it X-ray, be it CT, MRI, have grown exponentially, but the number of radiologists have not kept pace. So clearly there is a burnout that's happening, there is a shortage that is there. So through AI, you're helping improve radiologist productivity. So that's the basic core message. So here there's a huge unmet need that is there. But specifically to your question on the overall sector within health tech, this is a sector I would say is at a kind of a challenging phase today, right? So you take it over the last 2 years, the sector used to attract as much as $2.5–3 billion of capital till about 21 or 20, right, every year. But last year, 23, the sector probably could not even attract about $100 million of capital. And there are some 4–5 aspects. I think clearly one is the fact that, most of the companies in this space are probably just sitting on less than 12 months of cash today. So there is just, I would say, and how do they conserve cash and how do they move towards the profitability? The second point is the fact that how will these companies achieve profitability and growth at the same time? So that's again a big question mark. More importantly, valuations of these companies, especially the entire health tech space, are still not at a realistic level today. So with all of that, and the leader in this space, since I'm talking of health tech, I think we should not forget the fact that the majority of the capital in the health tech space has gone to the e-pharmacy space. And e-pharmacy today is at a situation where you're questioning the business model. That business model itself has gone through a transformation. And you're saying that what is the moat? How can just pricing be a moat for a company, for this sector? So the leader itself is facing challenges, and probably that is going to continue to be a laggard for the other segments to sort of, so beyond e-pharmacy, you have this B2B hospital, you have the telemedicine, you have some of those wearables, etc. And none of them have reached a certain scale or profitability. So I think it continues to be at some kind of this. So, and plus we've seen corporate governance issues. So clearly, again, these are things which have, clearly again separates out the quality players from the not so quality players. So I think, we are at that kind of a situation today.
Thank you. Now, moving to enterprise tech, I think some of you mentioned that. I think Gopal, what are you seeing in, because enterprise tech, I think SaaS multiples have come down, yet SaaS businesses are doing okay, or perhaps better in terms of profitability. Are there new themes coming up? What's exciting you in this space? And enterprise tech for...
markets will keep going up and down. So those are financial markets. We're talking of the behavior of enterprises. So the typical business in India is 5 years behind the typical consumer in terms of use of technology. right? You meet the average consumer, he's using world-class Wi-Fi, he's got digital identity, digital payments, he's got a smartphone in his hand. But you walk inside a typical business, it's still antiquated, and software does not run the typical Indian business. That is changing for two reasons. That traditional businesses are changing behavior, and this new breed of startups, post 2011-12 are being set up by a breed of entrepreneurs who are far more comfortable using software to run enterprise functions. So you could have a relatively small company set up post 2011 that's running its payroll, for example, on software, and you could see a very large company which is pre-2011, pre-2012, which is still running its payroll on Excel, right? So these behaviors are changing. Yes, spending on technology has slowed down. The refrain for most users in technology is that technology under-delivers in the short term, but we know that it delivers in the long term. Right now, consumers across the board are moderating consumption. Having said that, this is a huge trend in India of enterprises using software for different enterprise functions. We have invested in companies that serve many of these functions. We are a growth investor, so we make very limited bets. Those have worked out for us. And typically we invest in them when they've, let's say, order of magnitude, they have about, everybody talks about in dollars, let's say in rupees, somewhere between 60 and 100 crores of revenues from Indian businesses. As any tech entrepreneur, their dream is to earn hundreds of crores in revenue from US or European markets. Almost every company will try, not every company will succeed. And often the capital we provide our companies is to help them make the transition. We also have some skills that can help them. I've been helping companies, get dollar revenues now for over 26 years. So that's the typical sort of a playbook for us.
Thank you, Gopal. Very interesting. We are halfway through and we haven't heard AI in this panel, so it's probably a good thing because everything is packaged as AI. But, Hero, would you like to add any particular themes in tech or enterprise tech that you like?
By the way, I want to address the previous point that you mentioned around SaaS multiples. Probabilities may be pretty high that new multiple is the new norm. And the theory may be that with the help of AI, creating new codes is much, much easier. And it will have massive implication for SaaS businesses over time. Public market, we shouldn't underestimate them. These investors are exceptionally smart and they really value businesses on real multiples of cash flow. So sometimes, yes, longer term multiple goes up and down, but it reflects a lot of reality of what to come.
Absolutely, yeah.
So that's one point I thought I'll make around the impact of AI and what it means for SaaS businesses and SaaS multiples clearly. But
I'm glad you mentioned AI because otherwise they would have thought this is a old economy kind of investors and, we have a reputation to save here.
No, I mean, so private and public, they are all connected. That's what we believe in. And in the end, all of the businesses that we are investing either all the way from early stage to growth, eventual goal if is to bring them public someday, we have to really understand what's happening in public market. And around tech spending also, just 2 days ago when Adobe reported, Shantanu just came on TV and he mentioned about spending slowing down on the enterprise side. Clearly a different market. India market is different, things are growing in India, but clearly need to see how all these things are connected. Coming back to AI, you can think about things getting built out at different layers. And I think based on what we have seen, at least in India, most of the things that will get built out will be more around the application layer. However, when we spend time with entrepreneurs, at least we couldn't find anything that looked extremely defensive over long term, or what can be the moat. Also, in the first wave, there was a lot of call it hype or call it focus around LLM, but now a few things are getting built out around LQM, and some of these LQM models, for example, Sandbox AQ, that is a spin-off from Google, the team is doing some super interesting work. So from Indian entrepreneurs and ecosystems context, we are trying to see if within enterprise environment in more closed door settings, can you build out solutions that can create efficiency and optimization for enterprises that can run on, rather than LLM, on SLM. And that's the first way we have looked. We think there may be some more defensibility because you are training things on proprietary data. But we haven't done anything extraordinary in that space in terms of investment, if I had to put it that way.
Got it. Thank you. I guess, none of us have spoken about consumer, but is consumer a big thumbs up for all of you? Yeah? Obviously, health, consumer, Gopal. So I think consumer broad theme, let's move on to other topics. I think everyone likes consumer. There's no doubt, lots of successes. I want to go down to the metrics, and I think you said something about valuations not being there, and I think you made a great point about bridging the valuations, early stage expectations, and exit or public market expectations. So let's talk about metrics. I mean, what do you really look for as metrics in the early stage?
So Ashish, I'll just take a slightly broader view. We have had a chance to discuss this, so bear with me with a little bit of repetition from what we had in Aspire in the past. I do feel that at an early stage, there will be metrics, but there's only so many metrics that one can really look at. Enough companies that we do end up looking at are sometimes at a pre-product stage or pre-revenue stage. So I think we are trying to focus on the template. And the couple of points made by Hero, by Gopal, what you also alluded to in some sense, Ashish, is about the valuations. I think we had the healthcare correlation with the valuations as well from Visalakshi. Broadly speaking, the template that we are trying to build the companies from India needs to be a little more consciously thought about. And to that extent, I would say that if we are looking at the Indian markets, they are a lot more bulge bracket markets. We will not necessarily see every company racing up to become a 10, 20,000 crore or a 4, 5, $6 billion company in 8, 10 years. This has happened in the US, good for them. This has happened in China, great. But we've also seen recent data, and there's enough information on the internet that talks about the kind of cliff that it has fallen through in terms of investments in China in the VC space. So when you look at India, I do feel that the right template is to look at that bracket of $500 million to $2.5 billion. Enough good companies can be made. And if you're going to look at the journey as 25 years and not necessarily get bottlenecked by the fund size and fund tenors that we come in with, over the rest of their life, the founders will do good to build great companies from that journey onwards. So enough companies in India have been built at 25, 30% CAGR, and some of them are today, most of them are today in the Sensex or the Nifty. So that is the focus. What we are trying to say is that we cannot go wrong. We will burn money at the early stage, undoubtedly. So we are not trying to say, let's slip suddenly because profitability is a flavor of the season. Let's now build profitable companies. At our stage at which we enter and another 3, 4 years after that, it's impossible to do that. However, you can't go wrong with unit economics. You have to make sure that we are looking at, the fail fast mantra is great, but at what cost are we looking at it? And the enterprise of valuation, it's okay once in a while to lose a deal that is not so great. You have to oscillate and triangulate between, yes, great founder, big market, but the profit pool and the ability of the enterprise to drive that profit ultimately and convert into cash flows is going to be important. Speed is not a big friend on the Indian market side. So we have to factor for some of those as well.
No, that's a great point, because I think in every industry which is nascent or emerging in India for the last 20, 30 years, and Gopal, you're probably testament to that. I think people try to use international models and plant it on India, never works, right? And then say you need an Indian model. And I think finally what you're saying, Ashish, is that even in the VC space, let's not copy, Bay Area, West Coast models, China models. China created this, 10 billion companies, 15. Let's look at what's the right outcome is. Let's build it from a frugality of the Indian standpoint
Every
for the
vertical
Indian
has
markets.
something from India that can be taken to the globe.
Absolutely,
That's fine.
yeah. So I think that's a great point. Hero, metrics or criteria that you look for broadly?
Yeah, so for our early stage investments, we only look at founder product market fit, nothing else. So it's a pure founder bet. For our accelerate Series B type, where we invest when a business is around, let's say, 10 million revenue run rate, there we have a full process, but we spend a lot of time in understanding what are the global comps in public market, how do they trade, what kind of margin profile they have, what kind of margin profile this business that we are evaluating will have, what kind of ROC it can generate, and we use our own proprietary buy-side modeling to come up how it may look like in future and discount it back to fit into our internal IRR calculation. So very, very different analytical process, and a lot of it has been designed and incorporated from my public market hedge fund 15 years experience that I used to do that, yeah.
So that's great. So basically quantitative driven, work backwards from public markets and see, sustainable margins and growth rates and build from there. Great. Now coming to the left side of the spectrum, and what are the metrics that you look for, and particularly how have you managed to, and you've observed the startup ecosystem going up and down over the last 10 years. How have you managed to sort of bridge the expectation of valuation with and align it with your own metrics that you have?
Yeah. Hi. So for us, we are growth capital investing. We are a single sector investor, but within the sector, there are clearly multiple segments, right? So in the consumption theme, you will have healthcare services, you would have diagnostics, you would have domestic pharmaceuticals. In the competency, you would have global healthcare companies or pharma companies. So it's a model portfolio approach that we do. So obviously, concentration is very, very important. We can't have out of a 15 portfolio fund, we can't have 5 companies in healthcare services. So clearly, concentration risk is something which we will completely avoid. More importantly, as growth capital, there is a certain scale that we think that we want as a starting point, right? So at least a $10 million or $15 million sales, and how do we take this company from $10, $15 million to say $80 to $100 million in 5 years' time. So that's the broad pathway that one is looking at. But more importantly, at a starting point, we are paranoid about profitability. So even if it's like a small level of EBITDA margin, what is the positive cash flow that the company is generating, or visibility on that in the next 12 months, 15 months. So that's again very, very important. And this sector, again, the sector that we are handling, again, a lot of the companies are working capital intensive. So how is that working capital being managed? So those are some very, very important criteria there. And then there is also this consideration from an exit standpoint. Some of them might be early growth, some of them mid growth, some of them late growth. So what is the proportion that you want to have in your model portfolio? Companies that will go IPO versus companies that would go for a strategic takeout versus just a secondary sale kind of a thing. So these are some of the broad considerations, right?
80% of our capital goes into companies across a wide range of revenues. I said that earlier, anywhere from 50 crores to 300 crores in revenue. Very few of the companies we invest in this bucket are profitable, but almost all of them have strong evidence of product market fit, high margins, an ability to acquire customers at increasingly marginal cost, etc., etc. 20% of our capital goes into an entirely different kind of investing. We have been very good at doing management buyouts. So it's not just the 20, 30, 35-year-old entrepreneur. We also systematically look for professionals having a second wind in their career, right? 45 to 55-year-olds who are looking to turn an entrepreneur. For many of them, starting out from scratch is not the right thing. So helping them buy out businesses. And in today's day and age, the transformation is often around digital, leveraging new markets. You talked about consumer. And often we only talk about the transformation in digital as a channel. There's another transformation happening. We spend a lot of time thinking as to how the emergence of discretionary spending is changing the market and creating a demand for new kinds of products, like, egos here. Milk is branded, but eggs are not branded, right?
We had a big discussion this morning on
You had
exactly
a discussion
that.
on egos, right? And you can go wrong on these things, but India, 100 years ago in the US, 10% of all households had cars. Today in India, 10% of households have cars. So, this transition happened in Western markets a long time ago. The transition from non-discretionary to discretionary. So there is very little learning that you can lean on, right? And if it works, and of course there is a science to it as to how you can make it work, but I think that's a very fascinating transition, right? We're at the cusp of around this, this $2,000 per capita. It's a very interesting stage for a nation. So it's digital is one axis, and the change from non-discretionary to discretionary spending, and how that's going to lead to exponential rise in certain markets. You were talking about time. 30 years ago, for example, footwear was an occasional purchase for most Indians.
Yep.
Right? So, I invested in a company that made Hawaii chappals. And today it's worth a few $1 billion. Can you imagine? Right? So today it's a difference. Today maybe it's about premium burgers. Maybe it's about luxury goods. So things keep on changing. This consumption at the margin, which is going to grow exponentially, is really exciting.
No, that's great. I think with that, we're actually run short of time. We could keep going on and on. But thank you very much. Great insights about the sector, great insights about the metrics, and I'm sure lots of founders here have benefited from that. And thanks very much, all of you, for the insights.
Thank you everyone. A big round of applause for our panelists.